Bim. How are we, folks? Nick Masunda here, video number 21. I'm talking about reversion to the mean in this video and why it is of critical importance when you are investing. Why should you listen to me? I've been working in personal finance for over 7 years, so I just want to share some knowledge and help you guys make better decisions about your own personal finances. So I'm going to start by talking about what reversion to the mean actually is. So whenever you have a price chart of some sort of investment, a stock, commodity, currency, whatever it is, you'll see that there is short-term price fluctuations around a long-term kind of baseline or mean and average being interchangeable terms. So the short-term price fluctuations revert back to that mean. Okay, you can see that in the noise up and down, but it's following an average. So that's basically what reversion to the mean is, and it can help you as an investor make predictions about what's going on or going to happen to the price of an investment. Now, when you're looking at investing in mutual funds, this is of particular importance, and there's a bit of data that I'm going to share with you to show why. But I want to create a little bit of context first. Now, many of you will be familiar with the SPIVA data. SPIVA standing for S&P Indices versus Active. Basically what they do is they provide performance data, and it's very simple. They show the percentage of active funds that are beating their benchmark in the market. And the benchmark is always an index. Okay. Now, I'll get the website up. It's a pretty cool website. There it is. So in the United States, over 15 years, 12.02% of funds beat their benchmark. All right. And you can see all the different countries along here. We've also got Australia. So Australia, over 15 years, pretty comparable. 14.63% of actively managed funds beat their benchmark. Okay. Now, when people see this for the first time, I think intuitively they're surprised. Intuitively, they expect that if you have a fund manager that's expert at what they do, then the majority of them would be able to beat their benchmark, which is an index. An index is just a list of the largest X amount of companies in that market. So there's no special technique or algorithm for investing in an index. It's simply based on market capitalization. So intuitively, people think that you'd be able to beat the benchmark if you have expert skill at choosing stocks. But the data is what the data is, and the vast majority of actively managed funds fail to beat their benchmark. Now, that doesn't conclusively say that you shouldn't invest in actively managed funds. It tells you that in this case, over a 15-year period, in the US, funds, 12% roughly, will beat their benchmark. Okay, so there is a chance to get a long-term outperformance in the minority if you have a methodology or approach for selecting those funds. However, most people intuitively think that if an actively managed fund has beaten their benchmark for a certain amount of time, if it's sufficiently long, then that must be due to the skill of the manager or something inherent to that fund, and that's going to continue on into the future. But if anyone's read any marketing material from finance providers or service providers, you'll know that, or you would have heard the disclaimer that past performance is not a reliable indicator of future performance. And I think a lot of people poo-poo that, and because they recognize that it's a warning that has to be on the packet, so to speak. But this data that I want to show you right now would suggest otherwise. So if you look, at this table here, and this is from Little Book of Common Sense Investing by John Bogle, founder of Vanguard, massive proponent of index investing, obviously, or passive investing. So if you look at this table, it's showing you actively managed funds, a total of 1,777, categorized into fifths, into quintiles based on their performance relative to each other. Now, this is over 5 years, right? Now, if past performance is in any way indicative of future performance, then you would expect in the highest return fifth of funds, you would expect the majority over the next 5 years to be in that highest return category, basically, right? What we find here, this is over the next 5 years, is that only 15% of the original highest returning funds remain in that highest returning fifth. 13% come from the high performers, 14% from medium, 12% from low. 18% of the lowest performers are in the highest returning quintile in the preceding 5 years. So if you had have just picked a stock randomly from the highest quintile from the previous 5 years, there would have been less chance of picking a highest returning fund than if you had have randomly picked from the lowest returning quintile. So it seems almost random, and suggests that past performance in this case is actually not a reliable indicator of future performance. Now, that's just 5 years. We've got a table here for the next 5 years. So they've done the exact same thing, just over the first 5 years being from 2006 to 2011, next 5 years being from 2011 to 2016. And you can see very similar outcomes here. 13% of the highest return first 5 year funds, only 30% remain in the highest return quintile in the next 5 years. 17% of the lowest returning funds from the first 5 years are now in the highest returning quintile, right? So again, pretty similar. And it is counterintuitive. Like, you would think that if you looked at performance over a long enough period of time, 5 to 10 years, that would be enough. I think intuitively most people think that would be enough. But this data suggests that it's not enough to prove that the performance isn't random. That it's not luck but skill. It's not enough time to prove that. Okay, now to further sort of drive this message home, we can go back to the SPIVA data here and look at the percentage of funds that are beating their benchmark and how that changes over time. So you can see for large caps, this percentage, and this is the percentage that aren't beating their benchmark, getting greater and greater over time. Same with mid caps, same with small caps. And that's particularly low. I'm not sure what that may be a misprint. But anyway, point being, this truly does suggest that past performance cannot be relied upon as an indicator of future performance. Okay, so if someone was to embark on trying to select actively managed funds that would outperform over the long term, then they would probably want to look at other factors like who the management team is, what the investment philosophy is, and try and make a prediction based off other factors such as those. And just know that in chasing those greater returns, there is a greater risk. Okay, which is the nature of the risk-return relationship generally. But yeah, that's pretty much the bulk of what I wanted to go over here today, guys. So, and for what it's worth, I am not categorically against investing in riskier assets. I'm not categorically against active investing, but it has to be done with an understanding of the risk and reward potential. So that's there's a pretty good hint as to what that is in the data that we've just gone over in this video. So anyway, that's pretty much it, guys. Thanks for watching. I appreciate it. Take care. Bye bye.